Let's check.
What's happening, everybody? Welcome to the CoWaCo in the building for you all today. We got Leroy and Chris. And the CoWaCo stands for the company water cooler.
And we are here. Let's get to it. Let's do it. CoWaCo. Let's do it. I like that.
And
all right, Leroy. How we gonna start today, man? Where we going?
First, let me also mention.
I'm excited.
that you all actually like and subscribe to our YouTube channel. So just want to mention that. All right. So first, we're going to actually, motivate you all about keeping your money in the stock market.
Keep it in the market.
Yes.
Yeah.
So Chris,
that's what
you got anything to say about it?
Yes, sir. I got a whole lot to say about that. I got a whole lot. So now the first thing I want to say, everybody watching, appreciate you. Thank you very much. Even, 5, 10 people, 100 people, whatever it is, we appreciate y'all for tuning in. The importance of keeping your money in the market. If you look at any 10-year period, and I just want to say before we even start, Leroy, much appreciation to you. Thank you, sir. None of the, if we look at none of the information that we give y'all is going to be like, we know something that's not already out there. Everything under the sun has already been done. So we're just adding our perspective and our 2 cents on it and our interpretation of it. And then you take that and run with it. If you learn something, you let us know, because we're learning as well. We're not masters in this quite yet, but we're getting there. And once we get there, we're absolutely going to bring all of you all along that were here, from the early stages. And even if we meet you later in this journey, we're absolutely going to bring you along on that. So we, because it's all about building and it's all about growth. But the importance of keeping your money in the market, I would say 10, but some would say 20. I mean, listen, honestly, the longer the better, because there is not a single, there's not a single 10-year block where you put money in at the top of that 10 years and at the bottom of that 10 years, your money is worth less than what it was when you put it in. And then 20 and 30 years is even more unlikely. I think 10 years is like 1% chance, I think. 20 years is 0. So keeping your money in there, letting it grow, and then adding it over time is only going to further your wealth. Now, you got to ask yourself why that is, because these are assets, right? So you're putting your money in, I don't even want to say betting, right? But you're putting your money behind logic, sound, reasonable organizations whose sole purpose is to provide you, the shareholder, the owner, a return on your money. So if I give Leroy $100 on Monday and Leroy say, I'm gonna have your money back by Friday. If Leroy comes to me on Friday with $110, the next time he needs some money, he got it. Hey man, look, I know I asked you for $100 last time. I brought you $110 on Friday. I need $250 today. It's Thursday. I say, okay, well, he said, look, and I'll get you your money back on next Thursday. He's got a good track record with me. Now that was just one time, but if I give him the $250 on Thursday and he comes back to me that next Thursday with $300, hey, anytime you need money, you come to me, because I know you're going to add more. You're going to add value to that. I'm going to give you a product. I'm going to give you a tangible item, and you're going to multiply that for me. And then what can I do with that? Leroy ain't the only one that could borrow from me. Leroy come to me and say, look, I need $300. And I know he's going to bring me back more than $300 on Thursday. Somebody else might come to me that Thursday and say, look, I need $150. I'm like, well, if Leroy going to bring me back $350 from the $300 that I give him, let me go ahead and, okay, cool. Now you can get that $150. And I still have $2 left over to lend $100 out a piece to whoever might ask me for that. So it really, what it does is it allows you, and then of course you get into credit and you get into, really you get into like invisible money. I'm lending money that I don't have because I'm expecting, but then that's when you get into a whole new territory. But you keep it baseline, you keep it simple. I lend Leroy $300. Leroy brings you back $350. I can now loan out more money to more people and provide them with more opportunity. So if you're looking at it like that, investing always makes sense, because the likelihood, the longer period of time that I go waiting for Leroy to pay me back, the more money he's probably going to put with that interest, right? Now, we didn't even set terms and agreements. I didn't say, hey, Leroy, when you bring me my money back, bring 5% on top, bring 10. I didn't even do that. Leroy is my guy. He needs 300. He's got 300. He brings you back 300. That's cool. But in business, of course, it's like, hey, what are you doing for me? And the reason that I understand the fear behind investing, because no company can guarantee a return. So it's like, well, man, look, Chris, if I put $1,000 in the market, man, and a year after that, my money is only worth $800, I lost $200. And then I say, yeah. What did you invest in? What did you invest in? You know what I mean? What did you invest in? Was it quality that you put your money in? Because you can't just give any and everybody money. You can't just let any and everybody run with what's valuable to you. I'm not going to paint this piece of art that's valued at $1 million and just hand that to anybody. I need a trusted source, right? And if this company has been in business for 20, 30, 50, 100 years, and they have a track record of making money, that's who I'm going to put that money behind. That's who I'm going to put there. And it's so much more. We'll get into that as the show goes on, as we continue these episodes. But just when you want, honestly, first off, when you're thinking about the easiest way to make money, like the easiest way, give it to people who are smarter than you and let them make the money for you, because they understand that that money that they're using is not the end all be all. That is an avenue that we're using to get elsewhere, because the money itself is not, it's not important, right? It's the access and the opportunity that that money provides. So keep your money in long-term, 10, 20, 30. Ideally forever is going to work, because you don't have to worry about selling off anything that, quality. You don't have to worry about selling off anything that's not going to garner you returns over the long haul anyway. So the longer you keep it in, hopefully the better the company gets and the less that you have to sell as a result.
That is true.
The key, one of the keys to it.
Oh, say that again.
No, I was gonna say one of the keys to it. One of the things that's very important. So it's not like they do have methods where it's quick, you know what I mean? And you get into trading and you get into options and things like that. And you can, bounce back and forth as you need to. But that's when you get like really, really comfortable with it. First, you want to put all your money in long term, 100%.
And also want to mention too is we're not financial advisors. So anything that we say, this is for entertainment purposes only. So we're gonna let you all know that
this is for educational only, everybody. This is only for education. So any money that you lose ain't our fault, but any money that you gain is on us. You're welcome.
So we definitely have to let you all know that. So also to
I'm glad you brought that up.
Yeah. So also to piggyback on what Chris said too, with keeping your money in the market, is you have to think about your children too. If you have children, even if you're thinking about, even if you have nieces, nephews, this is for your family, for that generational wealth that you can be able to actually build for them. So you won't have to start over at zero. They won't have to start over at zero, because you will have basically that money built up. Assets, look at it as assets. You have it built up so they can be able to actually have something to be able to actually use if they want to actually, start up that business, purchase a house. So, oh, and then you should think about this. With these assets that you actually have, right? What Chris was talking about, actually being able to actually take a loan. I mean, being able to actually borrow, he was talking from the perspective of borrowing money, but look at it at this perspective too. With you actually having those assets, you can be able to borrow against those assets, just like how you can borrow against a house, so stocks, look at it as the same concept. Let's say, like, for example, you have getting up to like $50,000 or either $100,000, worth of assets. All right. So you want to start this business. Let's say you want to borrow maybe $30,000 against your assets, right? All right. So when you actually take out this $30,000, right? Guess what? Plus, you don't have to pay no taxes against these assets because you're just borrowing against them. So they've used that $30,000 and be able to actually, get this business going, because this business is going to make you money. So therefore, it's going to be easy for you to be able to pay that money back, and then guess what? You're paying yourself back and you still get to keep your asset. So,
and you get to keep the asset.
That's right. So,
and you can multiply that. You can do that more than once. So you can do that. And obviously, as time goes on, you're doing that with assets that have more and more and more and more value. And so also not tax advisors either. So
oh, right.
I know you didn't mention that, but that's important. If taxes go well for you, that's on us. We'll take credit. You're welcome. If they don't, that's not on us. But we are not tax advisors either. But it's very important that you understand that as you build along and you go along, you have that ability when you reach a certain level of, when you reach a certain amount of assets, the things that you want are going to cost more. So naturally, the things that you're naturally the things that you're swapping money for, if you will, is more and more expensive. And then you get to keep it at the end of that. So
yes,
it's a pretty solid reason too. And you don't have to start big. You don't need $1 billion to do. If you can only invest $5 a week, invest $5 a week. If you can invest $1 a day and $1 a day, whatever it is, whatever your amount, but do it consecutively. So you always are putting in, you're always throwing money towards assets.
Right. And you have different apps out there that will allow you to do the partial shares that he was talking about. You have like Webull that you can be able to actually use that allow you to do partial shares. Robinhood that allow you to do partial shares. Even Cash App allows you to do partial shares. So just keep that in mind as you like you said, like you don't have to have like a lot of money to be able to actually start in investing. So
not at all. And I think they all offer, I think all brokerages offer now partial. They have to, because everybody doesn't have $100,000 to put behind a company. So you should be able to get on any platform of your choosing and start investing right away.
Yes. So yes. All right. So we're going to move next to talking about patterns within the market. 9 out of 10, not 10 out of 10, but 9 out of 10, the market have a tendency to actually do a pattern. It happens all the time, and people that's actually, in the market and continuously to study it, they actually notice these patterns. So usually, like for example, the heaviest times that are in the market that usually have like its down times are usually March, and September are really heavy months. That's usually like the times whenever the markets are hit the most, seem like. And the reason why is because these institutions and hedge funds are actually taking their money out of the market for a profit. I don't blame them. They have to make some type of profit. And so even with that even happening, even during the March time, you even have where you have companies be doing their evaluations, also too showing what they have actually done for that particular quarter. That happens around March, and also September too. So you even have that going on, and then usually whenever something happens, like something like heavy happens, like in the news, while that actually is happening, then you got the news stuff going on, you got earnings going on, you have where like the institutions and hedge funds are actually taking money out of the market. So we know back in 2020 we had the pandemic happen, right? And so we had that happen, and then so that was one big news thing that happened during the month of March. And then let's think again. So when that happened, again, you had like institutions and hedge funds taking money out the market for profit. It's causing for the market to actually have an effect. And then you have where like the companies are doing earnings during that time. Bam, we got that going on. So you got a lot of stuff actually happening during that month of March. And then here in this particular month this year of March, we have Ukraine stuff going on. So so you got that going on. And again, it's a pattern. Institution taking the money out of the market, making profit, earnings. So think about the pattern, okay? So if you have that pattern, what usually happen after that pattern is usually after it's passed, the market has a tendency to start going up, but we get hooked
into the summer.
Yes, we get hooked into it because we're thinking like, oh man, we're losing money. What is going on? But just remember, it's a pattern. All right. I'm not saying it happens like that every single time, but the pattern usually 9 out of 10 it happens. So
well, and it's always before March anyway. It's a buildup. So you start seeing things make a run, and then what happens if I can get 40, 50, 60% back? I need to now make money and take money off of that, and that's going to take it down. And then that's the perfect time to get in because over the summer it's going to run up. And it's just, every year it ebbs and flows. But if you, look at it and you see over 10, 20 year period, $1 20 years ago, in terms of paper money or in terms of money that you can get things for in real life, is the value is cut. But in terms of assets, it might be up, who knows, right? Like this crazy number. So pay attention to that.
Yes.
In the real world, it might not, a loaf of bread might go from $1 to $1.05, $1.10, $1.20, and then 10 years later it might be $2.50, and then 10 years after that it might be, whatever it is. But your asset would have grown from maybe $1 to $5 to 10 to 20 to 30. Now you can buy all the loaves of bread that you want. So you have to make that distinction between those two.
Right. Yes. All right. So and then also, as I mentioned again, pay attention to September, because right after the summertime that he was talking about, right, we got the September month coming. So something might happen around that time. you know, getting close to that time, when stuff start to drop again, pay attention to the pattern. All right. And also even during the March and September time, I think Chris, you want to mention about the quadruple witching. It happened around that time also too. So it's like go ahead. Are you about to say something about it? Or?
Yeah, well, no, I was about to say that's when contracts expire for options, and this is definitely a more advanced play. So this will be later on down the line as we get further into the series, but that's options contract running out, companies taking profit, and it just being that time of the year every year that the market does that or it corrects itself. So you and the Federal Reserve as well, they do. I believe they have their annual. We'll 100% we'll do. I'm sure that those four things happen at the same time. And I don't have my Googles with me right now to break down each individual one, but those four things typically happen around the same time, or whenever it does happen, where they quadruple it takes place at that same time.
Right.
So
you're saying that basically it's something else that affects the market during that time.
Yeah, every year, and I want to say it's every quarter too.
Yeah, so it does it March, June, September, March, and December.
December. That's right. I always forget December because that's corporate tax season, December and January. So I always forget that. Yeah, but I remember September. I don't know. I think Labor Day, but for sure September, December, March, and June. There you go.
Yeah.
Yeah. Let me write those down so I don't forget. Look, we learning, y'all. We learning. Okay.
All right. So the next thing.
Hold up. I lost you. You good. Keep recording. You good. Let me get this.
All right. So the next thing that we're actually going to talk about is our favorite like stock or ETF.
Yeah, I'm gonna give y'all three because I got three. And they it's a lot more than three, but I'm gonna give three because I like where they headed with a lot of stuff. So I'm gonna give three. I don't know how many ETFs you got, but I'm just gonna give three individual companies.
Okay.
So I'm liking right now Walmart. Walmart is #1 brick and mortar retailer, and they also have a good dividend. Square is good too. I like Square for where it's gonna go right now. It's get in right now. They are like super discounted. Please get in Square, whatever you do. And then I'm gonna say Tesla. I was gonna say Apple, but I love it. Listen, Apple is, any smart investor will tell you Apple is the play too. You watch any of the other guys that are doing it, that are pioneering this lane for us to even be a part of. You look at Big Trap, you look at EYL, you look at those guys. Shout out to those guys for even making it possible for us to get on these platforms and talk about financial literacy. So we absolutely appreciate them for that. But I'm gonna say Tesla. I'm gonna say Walmart, Square, and Tesla.
Okay.
Yeah. Walmart for the dividends, Square for where it's headed in terms of the products they're about to start offering people, and then Tesla in terms of how they're going to totally like dismantle and reassemble energy. Like it's crazy. Like the stuff those people got planned, man. Oh my God. It's crazy.
And also to piggyback off what he's saying too, I don't want you all to actually miss out on stocks that does like stock splits. So there are actually two
for sure
stocks that's actually behind the stock split. One of them is, as y'all know, Amazon.
Great investment. Mm-hmm.
So that stock right now, Amazon is, let's see, Amazon stock right now. Let's see if I can actually pull it up here.
Was it 29 or 28? Should be 28, right? 2,800. Or no, it might be 3,000.
Oh yeah, it's actually. Oh wow, Amazon stock right now is $3,295.47. Man, so they're about to do a 20 split.
Does that sound good? Let me see.
Yeah, my sound. Yeah.
Okay. Okay. All right. It's good. Okay. It was choppy for a little bit.
Oh. All right. So Amazon again, their stock is $3,295.47. So whenever they do their stock split, whenever that time comes, whenever they actually do their stock split, you definitely want to be a part of after do the stock split, depending on what their stock is going to get up to. And I think their stock split is trying to figure what month. I'll have to get back to you what month it is. I think it's actually in July. June. It might be in June. So the Amazon
get this shirt back.
stock.
I'll show y'all this again.
It's gonna be splitting in June. I think it's June 6th, around that time, something like that. And then we got the other stock split gonna be Google. All right, so Google gonna be splitting also too at June.
Another great investment.
So they will be splitting in July, on July the 15th for Google, and their actual name is called Alphabet. The actual name.
That's what but they trade under GOOG. So
yes.
You'll be, I mean, just take the, you'll be good. Y'all, I mean, we all know at this point what it is anyway, because we use it every day. And so that's another reason that you want to invest in it anyway, is because honestly, it's a utility.
There you go, it's utility.
I mean, yeah. I mean, think about a day you go without Googling something.
And you don't have to, you don't have to wait till it's split either, and you don't have to buy a full share of it also too. Remember, we talked about being able to do partial shares, so you can actually, do partial shares, and then whenever it actually split, you can, purchase some more. So
yeah, it's a long game. It's a long. Do not get in thinking you're gonna make money overnight.
Right, that is true. Now, usually the stocks that actually does stock splits, the ones that's quality, what we talked about first, before, quality stocks, the ones that are quality stocks are the ones that are going to be basically the ones that's going to be able to grow your money whenever they actually do their stock split. Like, for example, whenever Tesla had split, it was like $400 something or something like that. Whenever it did its split, and now if you look at it now, look at where the Tesla's at now. Tesla is at right now. Let's see. Let's take a look here.
It's over 1,000 for sure. Because when they originally split, it was 1,600, and so they split down to. It was they split down to 400 or 500, and they're back up now to over 1,000. And that was what, 2 years, I think. Was it 2 years ago?
Yeah. Close to 2 years ago. Yeah. So $1,010.64.
Yep.
So it didn't go back down to 400.
That's double. Yeah.
So
I mean,
keep that
it was
in mind.
It was just 750 last week, I think, or a week and a half ago. So I mean, look, of course we're saying long term, because that's obviously the absolute best option. But when you look at companies that are really, really good, like, they'll get you your money back before, you know what I mean? But at least 10. You want to do at least 10 years. I mean, that's because you'll get to a certain number of shares where you'll be able to do what you want to do, which is the goal anyway.
Right. All right, you all. that's it for today. So thank you for tuning in to the CoWaCo, because we in the building.
We in here.
And remember to subscribe and like. Yes, go ahead, Chris.
Yeah, comment on it too. I would say comment on it too. I won't be reading the comments. I don't do that. But you know, Leroy's a lot nicer guy than I am, so he might actually read it. But me, but no. Stay tuned. Pay attention. My audio is going to be a lot better next time. I'll be able to fully express the range that I have vocally. But everybody who did watch, everybody who tuned in, we appreciate you. We have a whole lot more coming for you. It's on the way. Trust, building, slow build.
And eventually we'll be
we really think y'all appreciate it.
Yes, and we will be also giving out prizes, maybe through actual stocks, also through Cash App, because we can maybe actually give gifts out through Cash App through with stocks. So we're gonna be able to actually show some appreciation also to you all as a community. So just want to let y'all know that also too.
And if anybody's watching that can sponsor and you use your money and we just take credit for it, we do that as well. We sure do that as well. We can give scholarships on your behalf. We absolutely can. But that'll be that'll be a little bit down the way. Leroy and I have been invested now for years, so we do have we got a pretty, I would say we're good. We're not where we want to be for like 100%, but if you can help along the way and provide things for people along the way, and you build that community and you build that village, that that proverbial village, you can't lose from that point, so be on the lookout for a lot from the two of us. 100%.
Peace.
We out.